We'll take a look at shares of United moving after hours and moving higher as the company beat the street in the third quarter, earning $4.07 a share. That's 10 cents better than expected. Revenue coming in at $11.38 billion, just a little bit shy of expectations. The numbers within the numbers that people will be looking at: revenue per available seat mile up 1.7%. That's within the guidance from United. And keep in mind, they did take an impact, or felt an impact, from the reduction in flights to Hong Kong and to China in the third quarter. Because of that, their unit costs were up 2.1%, just a little above their guidance of an increase of 1 to 2%. But this is one reason why the stock is moving higher. The company raising its full-year earnings guidance from $10.50 to $12 a share. That was the previous guidance. Now it is $11.25 to $12.25 a share. And as you take a look at a reminder that tomorrow morning we are going to be talking exclusively with United CEO Oscar Munoz. Keep in mind that one of the questions we're going to bring up to him: what's been the impact of not having the 737 MAX? Guys, for the third straight quarter, they are not saying what that impact is, at least in their earnings report, but you can bet we'll be talking with Oscar Munoz about that tomorrow morning exclusively on Squawk Box.
Phil, thank you very much. We look forward to that interview tomorrow. For more reaction to the earnings right now, we're joined on the phone by Darryl Genovesi, airlines analyst at Vertical Research Partners. Darryl, thanks for joining us. Your first take on these numbers?
Well, I think it looks a little bit better overall. The third quarter EPS at 407 is about 12 cents better than where the consensus was set up. The 1.7% unit revenue growth is about 20 basis points better compared to the midpoint. United had said intra-quarter that expected to be at the midpoint, so this is slightly better. And then the 0 to 2% unit revenue expectation for the fourth quarter is probably a little bit better than where I think investors were expecting as well. Generally speaking, the questions that I've been getting from my clients over the course of the last week or so would have led me to believe that people were looking for a roughly flat midpoint. So the 1% midpoint is a little bit better on the top line. On the unit cost performance here, you do have a slight upward revision in the unit cost expectation for the year at 1.2% now. This compares to the prior expectation for 0.5 to 0.1%. So 0.5 to 1%. So we're about 50 basis points higher. It looks like they're experiencing some higher cost growth in the fourth quarter. So I'll have to go through the release in some detail and figure out what exactly is happening there. But I would imagine that some of the capacity reductions are having a little bit of of a negative an upward effect on the unit cost growth there. But overall, the fourth quarter 7 to 9% adjusted pre-tax margin expectation is probably about in line with what people were expecting coming in, with the top line better and cost a little bit higher offsetting it. I would highlight also that United has tended to provide a conservative guide. I think people will probably view this, the updated midpoint as perhaps the low end of what they could feasibly be expected to do.